I recently began exiting my 230 share position of Realty Income, and I want to share with you exactly why I started doing this. But first, a quick disclaimer. I am Russ, a welder. I am not a financial professional, just someone that is passionate about investing and learning. So this is not financial advice. I'm just a guy that is sharing what I'm seeing and my thought process. This all started when I was reading through comments on Seeking Alpha, which, by the way, continues to be one of my favorite research tools, as you'll soon see why. And you can find my affiliate link in the description below for a discount and a free trial if you want to check that out. And while looking through information and reading comments about Realty Income's Q2 earnings, I came across this comment from someone with the username Scotty Bummage. And it really caught my attention because it said they created a metric, quote, short-term weighted average cost of capital to justify their shareholder destroying spread of return over invested capital over WACC. And I'll shorten it for you, where he said, I saw a figure on their investor deck where they consider their reinvested free cash flow to have a 0% cost of capital. I'm out. This is a red flag. And then he also said, because that money is equity capital, and any money they have that can be distributed to shareholders is shareholder equity, so it's not free money with a 0% cost of capital, which brings down their weighted average cost of capital, or the WACC. So after reading and researching and digging a bit deeper, I think I discovered a bit of an issue that I think every single Realty Income investor needs to be aware of. But before we dive into that, I want you to understand weighted average cost of capital, or WACC, which might sound boring or whack, but stick with me here because it really could affect your returns. Think of WACC like your personal finances. If you have a mortgage at 6% and a credit card at 20%, your overall cost of money is somewhere between those two, depending on how much you owe on each, which is exactly what WACC does for companies. For REITs like Realty Income, they use two types of money: equity from shareholders, who expect around 7 to 8% returns, and debt from bondholders who get around 5%. When you mix those together based on how much of each they use, you get their true cost of capital. And here's the golden rule. Any investment must beat your WACC to create value. If you're buying properties at 8% cap rates, but your cost of capital is 6%, you're making money. But if your cap rates are 7% and your cost of capital is 8%, you are actually destroying shareholder wealth. And this is the part that makes this situation so much worse than it used to be. When interest rates were near zero for over a decade, companies could get away with sloppy WACC calculations. Even if you were off by 100 basis points, or 1%, you could still make decent investments. But now, with rates at 5% and rising, every single basis point matters. What used to be a minor accounting quirk is now a deal breaker because the margin for error has completely disappeared, which is why I'm so concerned about what I discovered. So allow me to show you, dear dividend investing viewer, yes, you, exactly what I found in Realty Income's Q2 presentation. And what Scotty Bummage is talking about, it's how they calculate what they call their nominal first year WACC. So here we have 50% equity at 7.4% cost, which is the adjusted funds from operations yield, 35% debt at 5% cost, which is the 10-year unsecured rate, and then 15% free cash flow at 0% cost. And for you math nerds out here, this is how you get to that number of 5.5%, which was rounded up from 5.45%. If you burden retained cash flow at Realty Income's current dividend yield of 5.62% as of this recording, the true WACC would be about 6.29%. If you instead treat that 15% as full equity at 7.4%, the WACC is about 6.56%, which both of those numbers are materially higher higher than 5.5%. They're literally treating 15% of their capital as completely free money, which artificially lowers their cost of capital. So after spending time wrapping my head around that, and don't feel bad if it's a little bit over your head, but this should make sense by the end of the video, it got me thinking about one of my other favorite REITs, which is Agree Realty, ticker ADC. So I looked at their latest investor deck, and on slide 13, they show under the titled Disciplined Capital Allocator slide, they specifically call out in red letters, quote, using short-term debt and adding unburdened free cash flow artificially improves cost of capital by approximately 80 basis points. Check out how ADC calculates their WACC on the left side, 75% equity at 6% and 25% long-term debt at 5.4%, giving them a WACC of 5.8%. They don't even have a retained cash flow line item because they treat it correctly as equity capital with the same 6% cost. But when you look at the peer WACC calculation on the right, it's exactly what Realty Income is doing. 65% equity, 25% debt, and 10% free cash flow after dividend at 0.0% cost. Agree Realty is literally calling out their competitors' accounting tricks. And as they say in the red, when you artificially improve your cost of capital by approximately 80 basis points, you are artificially making your capital look cheaper than it really is. So check this out. As I was preparing this video and going to get screenshots, when I went to the Seeking Alpha comment thread, which I have linked below, to my surprise, Joey Agree, the CEO of Agree Realty himself, jumped into the comments to back up exactly what we're talking about. He said about the retained free cash flow, and I quote, "It's equity-like capital that could be returned to shareholders or utilized to pay down debt. It does not have zero cost. While it may be the cheapest form of capital, you have to burden it." And he added that retained cash flow having zero cost would defy basic opportunity cost logic. You could simply pay down debt, and at least the cost of equity should truly be applied. So why is this all such a big deal, Russ, you ask? Well, let's break it down. When Realty Income treats retained cash flow as free, they're making their capital look 80 to 150 basis points cheaper than it really is. Think about it this way. What Realty Income claims is that we can buy this property at 7.2% and our capital only costs 5.5%, so we make 1.7% spread, which is a good deal. But the reality is that they can buy this property at 7.2%, but their capital actually costs 6.5% plus, so they're only making a 0.7% spread, which is barely worth it. It's the same property, same actual costs, but the accounting trick makes bad investments look much better. Joey Agree, and again, he pointed out that you could simply use that cash to pay down debt, which would save you the interest expense, or you could return it to shareholders who could invest it elsewhere, so either way, there's a cost. When you artificially lower your cost of capital, you end up accepting marginal investments that barely create value, or worse, actually destroy it. And that led me to another concerning metric that I found. Using SimplySafeDividend.com's return on invested capital for Realty Income looks to be roughly 3%, while a burdened weighted average cost of capital is 6.29%. That implies they're earning several percentage points less than their cost of capital on recent investments that they made. That gap suggests those deals may not create as much shareholder value or potentially destroy shareholder value. And taking all this into consideration, I thought it was pretty telling that on their Q2 earnings presentation, I calculate that 76% of their investments last quarter were in Europe. And I think this is probably directly related to the WACC problem, because when your domestic deals barely make economic sense, you have to chase higher cap rates wherever you can find them. And as Sumit Roy said on the call, Europe offers less competition, cheaper borrowing costs, and higher yields from fewer competitors trying to buy properties, but as I've found, it could also add currency and regulatory risks that may not fully be reflected in their calculations. All this made me appreciate Agree Realty even more, but Agree Realty isn't perfect. Their return on invested capital is about 3% as well, versus a 5.8% properly calculated WACC. But at least they're being transparent about their real costs and calling out companies that manipulate their WACC calculations. And from their most recent earnings report, their acquisitions at a 7.2% cap rate versus 5.8% WACC actually creates value, unlike Realty Income's 7.2% versus a more realistic 6.29% barely positive spread. Look, I'm not trying to scare anyone out of their shares here, but what I am doing is trying to share information that can help us all be more informed investors, because we're all trying to make the best decisions that we can. And when I see this level of transparency from Agree Realty versus what looks to be pretty blatant financial engineering and manipulation from Realty Income, it makes the choice really clear that I think Realty Income is not as strong of a company as Agree Realty is right now. Even though Realty Income has been around for 56 years and they're one of the biggest REITs out there, that's kind of creating a bit of a problem for them, and it's why I started investing in Agree Realty not that long ago. The monthly dividend from Realty Income is nice, but if the underlying economics don't make sense, they could struggle to grow, and you're not being properly rewarded for your risk, and you really are buying something that is more like a bond. This whole rabbit hole that I went down started only because of reading the Seeking Alpha comments, which is why I say some of the best discussions happen in the comments, and you even find CEOs like Joey Agree popping in. So if you're not using Seeking Alpha for your research, you really are missing out. I really want to hear your thoughts on this. Do you think I'm overreacting? Have you noticed other REITs using similar accounting tricks? Do you think this WACC manipulation is as big of a red flag as I do? I think the comments section is going to be pretty lively on this one, but that is cool because I've learned a whole heck of a lot from our comments as well. But I wanted to share what I learned here, and I think that this is information that can make all of us smarter investors and hopefully make more informed investment decisions. And if you do want to see what this welder is buying and investing on, click the link below, follow me on Blossom if you would like to, or sign up for the free and fantabulous weekly newsletter where I share all these stock portfolio moves and some stocks about to go ex-dividend and some interesting investing thoughts that I'm having with you every week for free. So don't forget to let us know in the comments below what you think about this. And in this floating little box next to my head, I didn't plan it out this way, I swear, but recently I had a chat with the one and only Joey Agree, nice enough to come on this channel. And we talked about ADC and the safety of their dividends. So if you click that floating little box next to my head, Joey and I will tell you all about it there.